Hey champ, ever felt investing is too complex? Don't want to spend a lot of time researching individual stocks just to lose money because you don't know if you're picking the right investments? There has to be a better way. Well, there is. Rather than investing directly yourself, you can invest in a professionally managed fund. You can either select an active fund that tries to beat the market or a passive fund that tries to track the market. There are benefits to both strategies. Let's start with a passive fund. A passive fund will try to track the market return of an index such as the Dow Jones or S&P 500 for the US. Each country or region has their own index, which is considered as their market return. Here are some other examples of indexes from other countries or regions. The market index is created by adding companies based on the size of their market capitalization. So a larger company will have a larger weight in the index than a smaller company. A passive fund would replicate the weights of companies in the index to achieve the market returns. There is no research done and there's minimal deviation to the weights of the companies in the index. There may be slight drift at times, but passive funds will periodically rebalance the weights of the companies to the market weights as the prices and market capitalization change over time. The benefits of investing in a passive fund is its lower cost. There's no investment team which has to research companies and make investment decisions. There's only a team which rebalances the portfolio over time as the market index changes. Since this is relatively simple to implement, which is just to follow the market weights, this is an easy way to get access to a diversified portfolio. However, unlike an active fund, there's no chance to outperform the market. You only expect to achieve market returns, less operational costs. Market indexes such as the S&P 500 are generally considered as the benchmark for the market, and active funds will try to outperform these indexes. To achieve superior results to the market index, an active fund will need to have an investment team to research companies in the index and have an investment process for implementing those ideas into the fund. So an active fund will have different weights to the companies than the market index and will be making active investment decisions when to buy and sell securities in the fund. With an active fund, the sole purpose is to outperform their respective market and benchmark. They'll have teams of people dedicated to doing research on companies and an investment process which attempts to be superior to market capitalization weights of the index. They will take active bets with their positions. That is, go overweight companies they think will perform better than the market expects, and go underweight companies they think will perform worse than the market expects. They may also have a different number of companies, usually less, in their fund compared to the market index, but this depends on their investment strategy and process. The benefits of an active fund are, if this investment process works, they will generate better performance than the market index. And over time, the better performance will compound into better long-run returns. But investing in these active funds are not free, as there's an investment team required to do investment research. There is an additional cost required. There could be a flat fee and/or a performance fee which shares in the returns made by the fund. But even with these additional costs, if the fund performs well, it could still outperform the market index returns. The risk with an active fund is that they can still underperform the market index. With all things investing, there's no guarantee of performance. So if this occurs and the fund underperforms for a significant period, you will receive lower return compared to the market. Paying the higher fees will also increase the risk of lower returns compared to the market. And another stipulation of active funds is there may also be other terms and conditions to consider, such as minimum investment sizes, which may be several thousands of dollars to start, lockups and withdrawal limits. These are not necessarily a bad thing for investors, depending on their investment preferences and goals, but it does limit access to these funds for investors starting with smaller capital base, i.e. less than $1,000. So another benefit of passive funds, as since it is easier to implement, these index funds can have larger scale and can offer smaller investment sizes to start, i.e. less than $1,000. Now, that's not to say there's no benefits of an active fund, as the potential for outperformance compared to the market could be significant over time, but when deciding your investments, you need to assess whether the fund is appropriate for your investment goals. Active funds will have more stipulations, like minimum investment sizes, and are generally less appropriate for someone starting with a smaller capital base. While passive funds are generally more appropriate for more people and are easier to access with smaller minimums to start. So if you wanted to be a lazy investor, you could build wealth by investing in a passive index fund. If you assessed a passive index fund was appropriate for you, you could automatically invest funds each month in a passive index and build your position over time. You won't need to make individual company investment decisions and would have a broad diversified portfolio at a lower cost. Market indexes have historically performed well over time, with the S&P 500 having a long-term average return of 7.1% per annum. So if you achieved 7.1% return per annum, you would be doubling your initial investment roughly every 10 years. This is a proven and lazy way to build wealth over time. Let me know in the comments if you prefer to invest in a passive fund or an active fund, and give me a thumbs up if you found this useful. I've also made other videos explaining other financial concepts such as diversification and compound interest, so check those out if you're interested, and subscribe to my channel to get notified from my latest videos. Thanks for your time and attention, and until next time, keep being a champ in your financial journey. Cheers.